Next up is Alicia from Cabot, and here's what she writes. I'm 43 and recently inherited $175,000. I'm helping to pay for my kids' college education, thankfully not too expensive with scholarships, she puts in parentheses. But I'm not sure what to do with my inheritance. Do I pay off my mortgage? Do I invest it, even with the recent market conditions? Good question. Thank you for that, Alicia. Recently inherited $175,000. So two things first. The first thing we need to ask, Chad, is how did that $175,000 come to her?
Right. And so I kind of explain this to clients. What is the wrapper around that money?
Yeah.
So there are different types of wrappers around the money. And when I'm saying that is it a pre-tax or is it qualified, non-qualified money? Those are the types of things that we need to find out first, because we need to understand the tax consequences for either withdrawing those monies or did she receive a step up in basis? And so if we start to liquidate those assets, what is the tax consequences for doing so?
So if it came to her through a bank account, a savings account, life insurance, there's likely not too much to worry about on the tax side. But if it is in an IRA, for instance, and it was, we don't even really, it doesn't tell us where she inherited it either, right? So let's walk through that. If it was from a parent who had passed away, then she's the next generation on that IRA. And inherited IRAs, the way they are taxed and the way they are required to be withdrawn, I guess the way their tax hasn't changed, but the way they are required to be withdrawn has.
It has. And so, previously, prior to, I believe,
2020,
then you could stretch that tax over your lifetime. So the IRS said, hey, you've inherited this. Taxes are still owed on these assets, and we are going to allow you to stretch those over your lifetime. They came in and basically said, hey, you got 10 years, and you've got to withdraw these assets out of that particular IRA and into, basically, I call it washing through the tax system, paying the taxes on them, and then you're able to utilize those assets as non-qualified monies moving forward. Mm-hmm. So the game has changed a little bit with those withdrawal requirements, but if it's inherited money like just cash in a bank account, let's address that. What can she do with that money? And she's asking, hey, do I pay off my mortgage? Do I invest it? And I'm a little bit scared with the market.
Mm-hmm. Yeah. So aren't we all, right?
Yeah.
I mean, this has been one prolonged downturn, and it's been really wild to watch the ups and downs of the news that comes out when it comes to the economy and the markets. I mean, one day it's great, one day it's bad, and we're still in this uncertain time. But the reality, I think I would say first, if you're uncertain about investing dollars that are on the sidelines into the stock market, I would say, first of all, there's never going to be a time where things aren't uncertain. I mean, that's just reality. We've got a chart up in our office here that talks about all the world events that have taken place over the last, since the 1920s, right? And we've had world wars, we've had financial crises, we've had all kinds of threats to the ongoing success of the American economy, but they have all been blips on the radar, and we've continued to go up. Now, so don't let uncertainty keep you from investing. We also have a chart that shows us that even in quote-unquote down times in the market, you can have some pretty good days, and how important that is. This is actually from Hartford Funds, and I love this. On the right side of that graphic for people watching on our video version, it shows us the S&P 500 index returns, the average annual returns from 1993 to 2022, so basically the last 30 years. And it shows you the hypothetical investment of $10,000 would grow if you were fully invested over that 30-year time period to about $178,000 and some change. But if you missed just the 10 best days, 10 days over 30 years, your return would be 54% less.
Wow.
That's amazing. And then you stretch that out to those other green bars. If you missed the 20 best days, it's 70-something% less. And I can't read it from here. That's the reason I said 70-something. And if you miss the 30 best days, look at the impact it has. Huge difference in your overall returns. Now, the S&P 500 is an index. It cannot be directly invested into, and these are historical returns and not indicative of future results. But on the left side, I find this even more fascinating. So, okay, we don't want to that makes the point on the right side, Chad, that we don't want to miss the best days of the market, just the very few best days. But we're in a bad time right now, right? So everything seems like the market seems like if you really thought about it psychologically, the market's going down every day, right? We don't really think of it going up. But the left side of that graphic, if we can put that back up, shows us that the best days in that same 30-year time period, 52% of them, these are the 50 best days, 52% of the 50 best days happened during a bear market, which we are still technically in. We are flirting with going into a new bull market, and that's defined as the market closing 20% higher than the most recent low. So during the first 2 months of a bull market, 26% of those 50 best days occurred. So you're talking about more than three quarters of the best 50 days over 30 years happened in a time that we could say is right now.
Yeah, and
right?
for Alicia, when we say, hey, are you ready to invest this money?
Yeah.
I think that just by seeing these charts, it shows that you've got to stay invested.
Yep.
So the very first thing we'd want to do with the Alicia is say, all right, number one, what are all of your debts? Is it just the mortgage? How do I know if I need to pay off the mortgage? Or what are your other debts? Do you have some other things out there looming, some expenses that you need to take care of first? Obviously, the kids' college is a concern for her. But in this chart, it shows that if you start investing, you want to stay in for the long term. Mm-hmm. You don't want to be reactive and start coming back after this inheritance money just because you thought, hey, I need to get this invested. It really depends on what you're doing elsewhere as far as the other debts and the other expenses that you had. Now, one of the things we want to make sure is she's got an emergency fund.
Right.
That's going to be the first, right?
Yep.
And that will allow her to determine if she can invest the rest of that. So there's a lot of variables in this, but I would say that don't be scared to invest this inheritance. But sometimes just going directly and saying, hey, I'm going to get rid of this mortgage right now may not be the most efficient way to get the plan started.
Yeah, think of your goals in terms of immediate, intermediate, and long term. So divide them into three pots there. And Chad's already mentioned the emergency fund. That's the immediate, right? There may be something that you need to pay off debt. That could be an immediate need, but also having an emergency cash fund to not have to go into debt the next time you need something. Make sure that's taken care of. That box is checked. And then intermediate. Do you have some goals? She mentioned helping her kids pay for college. It doesn't look like that needed to be part of this inheritance money. But if that's a goal, that needs to probably come in to play after the long-term goals are set. Because we would say to do that part in reverse order. If you've got a trip or something like that, I think that falls into let's make sure we're on track for our long-term goals first. We use the analogy a lot when it comes to kids and education is make sure that you've secured your own oxygen mask before you help others.
Absolutely.
Sounds kind of callous, selfish maybe.
Right.
But
right.
Talk about why that's important.
Well, I think, you being on your own financial foundation and being firm allows you to give you the flexibility to help your children. Mm-hmm. And we've seen that. And so to those parents that are out there trying to put those kids first, and we all love our children, but being financial, having that financial foundation on yourself will allow you to not only help them now, but in years ahead.
Yeah, and I think important to think about if you take care of your own financial, or if you don't take care of your own financial future, because you helped your kids in the here and now with college, then somebody's going to have to take care of you, right? And guess who it's going to probably be? It's going to be your kids. So it's thinking about not being a burden later down the line for sure financially. So they can always get out of a student loan, pay off a student loan, not get out of a student loan, but get through college without having the funds to pay for it in a cash flow situation. But you won't be able to get those years back when it comes to planning for your long-term retirement.
But to sum it up, I think for Alicia, number one, she needs to figure out what the consequences or tax consequences are for liquidating any of those assets and using those. And so definitely if there was some significant tax consequences, it wouldn't probably be a great idea to liquidate that all in 1 year and pay off the mortgage.